Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update about the economy and the investment market, so hopefully you can better position your portfolio for 2012. I look back at 2011 and it really was probably one of the more volatile years or most volatile years I've seen in my personal investing career for 26 years. Just a lot of ups and downs, and the S&P basically ended up really almost flatlined for the year. Other indices were down a little bit, some were up just a tad, but generally speaking, just a lot of volatility, and often that's unnerving for investors. One of the most important things that I'm going to bring to you for 2012 is make sure that you don't get complacent with your portfolio, that you really do have an investment strategy in writing, or the person you entrust with your money is really a money manager, not a wealth manager, not an advisor, not a so-called financial planner. Make sure their job is to manage your money, and there is a big difference. So I just want to bring that to you. We had a fabulous show on Sunday. In fact, we talked about 9 items that were important for 2012, and we wrote about those in our newsletter. So I hope all of you have read those. We talked about our top 3 income opportunities, our top 3 growth opportunities, and 3 investments to avoid. We're actually going to do a similar show come Sunday on more in-depth on these topics come Sunday. So we're going to talk more about that. I really look for some great opportunity in the first half of 2012 in the U.S. marketplace. In fact, I think the U.S. marketplace, based upon our relative strength rankings and how we are currently positioned and fully invested, I may add, in U.S.-based equities in various categories, I think will outperform the emerging markets on the first half. What we're waiting to see is some kind of turn in the emerging markets. So don't brush off, don't throw away the emerging market economies. You're always going to have temporary bouts of underperformance. You want to wait till they get relatively stronger and the trends correct, and then you can re-add those back to your portfolio. As I've always told investors, our GTOP, our Global Tackle Opportunity Portfolio, is run on a relative strength on a special proprietary formula we use in-house at Resney Wealth Management. It's proven to not only reduce volatility, but also increase return over time substantially. So at the end of the day, it's making those adjustments following your strategy. Whether your strategy is a value strategy, whether it's a book to sales strategy, whether it's a growth strategy, whether it's relative strength, whatever strategy you deploy, just make sure you do follow it. Not making those timely changes is what really costs investors, or falling in love with an investment. I love the emerging markets, but again, when they're not working, they're not in the portfolio. And I would stress that they haven't been working for a little bit of time here, and it's time to really be in the areas that are the most relatively strong. We talked on Sunday's show about the small cap side of the market in the U.S. We have a major stake in that, and that has really outperformed many other sectors in the world investment markets over the last 3 months or so. I continue to like small cap, and as long as it's relatively strong and within the top 5 sectors within our portfolio, it's going to continue to be there. I would definitely look at income-oriented for you income-oriented investors. I think one of the areas that is definitely going to be one of the areas of the most opportunity for income investors is going to be the emerging market bond market. Not the equity market for income, but emerging market bonds. I think they are going to greatly outperform U.S. bonds, especially long bonds. I continue to see long bonds falling in value. These things are grossly overvalued, so watch for any kind of long-term bond. Anything with more than a 10-year maturity is long-term in nature to me, whether those are corporates, whether those are government. And by the way, government bonds are the most overvalued bonds right now and carry the least return and carry the most downside risk potential of any bond that I see out there. So I would very much avoid long-term, especially government bonds, at all costs. Do not chase yield. Too many investors have done that, or chase return. As an example, long government bonds did fabulously well, and what happens is people will buy what's done well in the past, not understanding why they've done well. Be careful. Bonds go up when interest rates go down, and bonds go down when interest rates go up. So remember, it's like a teeter-totter. If interest rates are at all-time lows right now, they can't go a lot lower. When rates eventually start stabilizing, going up, you could see a catastrophic loss in long-term bonds. This is Brian Resney. Make sure you do listen to Sunday's show. It's going to be fabulous. We've got some key incoming growth areas you want to learn about. And as always, if you want to contact my firm about managing your wealth and you want a second opinion about what you're doing, call our office. I urge you to make 2012 as good as it can be. Don't settle for bad advice. Don't settle for mediocre. Call our office. We would love to help get your portfolio back on track for your retirement. This is Brian Resney. Have yourself an extremely profitable week.